Welcome back to the Deep Dive. Today, we are focusing on a document that I think most people would instinctively run away from.
Oh, absolutely.
It's dense, it's technical, and it usually sits in a PDF folder gathering, digital dust until the night before an exam.
Right.
We are unpacking the ACCA Strategic Business Reporting, or SBR Examiner's Report for the September and December 2025 sittings.
It sounds dry, I get that. But if you are in the finance world or specifically trying to get that qualification, you shouldn't see this as a report. You should see it as a battle map.
A battle map is a good way to put it.
Yeah.
Because reading through this, it felt like a postmortem of a very specific conflict. It doesn't just tell you the answers, it tells you exactly where the casualties were. It shows where candidates walked right into a trap and where they managed to outsmart the system.
And that is the mission for this deep dive. We aren't just going to recite accounting standards. We are going to extract the specific pitfalls, the technical misunderstandings, the behavioral errors, and the strategic blunders that the examining team identified.
And it seems like the big theme here is that it's not just about what you know.
No, not at all. The difference between a pass and a fail often isn't about how much you know, it's about how you think.
It's the shift from being a calculator to being a consultant. So let's start with the strategy. The report opens with general comments, and there is this heavy emphasis on what they call the golden rule.
The golden rule of SBR, it translates simply to marks equal minutes. It's the economy of the exam.
Right.
And the report highlights this because it is the single biggest reason candidates fail before they even answer the final question. They go bankrupt on time.
And the report specifically points the finger at question 1 for this, doesn't it?
It does. Question 1 is the beast. It involves group accounting, consolidation, technical workings, and usually a spreadsheet. It is dense.
So what happens?
What happens is candidates get silo vision. They dive into the spreadsheet to make it balanced. They obsess over a single adjustment, and suddenly they have spent 50 minutes on a 25-minute task.
And the tragedy there is the opportunity cost. The report mentions that candidates are losing easy marks later in the paper.
Exactly. They arrive at question 4, which might be a relatively straightforward discussion on a new standard, but they have 5 minutes left. They write 2 lines.
And fail.
And fail. Not because they didn't know the answer to question 4, but because they over-serviced question 1.
It's an efficiency problem. The report actually suggests a tactic that seems obvious, but I guess people rarely do. You don't have to answer them in order.
It's permission to be strategic. If you scan the paper and see that question 3 is on a topic you love, maybe it's an ethics scenario you intuitively get, do that first. Bank the marks, secure the psychological win, then go wrestle with the consolidation.
Speaking of wrestling, the report brings up another huge barrier, the rote learning trap. This felt like a direct critique of the education system itself.
It really is.
It says answers that simply present knowledge-based facts score very poorly.
This is critical for anyone listening. In lower-level exams, you get points for definitions. Define an asset. You write the definition, you get the mark.
Simple enough.
In SBR, if you just vomit the textbook definition of an asset onto the page, you get 0, or close to it.
Because they assume you know the definition. They want to know if you can spot one in the wild.
Precisely. You are acting as a professional advisor in these scenarios. A client doesn't pay you to recite the definition of a liability. They pay you to tell them why their specific lawsuit is a liability.
It's all about application.
It's all application. If you aren't linking the rule to the specific facts of the case study, the names, the dollar amounts, the dates, you aren't answering the question.
One of the most painful, unforced errors mentioned in the general section was about the spreadsheet functionality. This actually made me wince.
The plus-minus disaster.
Yes. The report says a significant number of candidates are getting the math right, but the direction wrong.
This is purely mechanical, which makes it tragic. In the exam software, for certain adjustments in question 1, you have to input a negative sign to reduce a figure.
Right.
Candidates are calculating the number correctly, say a $5 million impairment, but they type it as a positive.
So instead of reducing the asset value, they increase it.
And the spreadsheet auto-sums at the bottom, so your final figure is wildly off. You lose marks all over the place. The report just begs students to use the practice platform. Don't let your first time using the software be on exam day.
Let's get into the specific campaigns. Let's talk about Woodfleet. This was question 1.
Woodfleet Co. This was a classic group accounting setup. You have a parent company, Woodfleet, and they are disposing of an associate company, Barton.
Now, disposing of an associate sounds like standard fare. You sell the shares, you calculate the profit or loss, sales proceeds minus the carrying amount. Basic math.
The math is basic. The accounting principle is where people tripped. The associate, Barton, was a foreign entity.
Okay, so a different currency.
Right. And over the years, Woodfleet has been translating those financials. And when exchange rates move, you get gains or losses.
Which don't go into the main profit and loss account.
Correct. Accounting rules say you don't put those paper gains or losses there. You park them in other comprehensive income, or OCI. They sit there in a separate equity reserve.
Okay, so they're sitting in this holding pen called OCI. Then Woodfleet sells Barton.
And this is the aha moment that candidates missed. When you sell the foreign operation, you have realized those gains or losses. You can't leave them in the holding pen.
You have to recycle them.
You have to recycle them. You take that accumulated amount from equity and dump it into the profit or loss calculation for the disposal.
So if you had $1 million of exchange losses sitting in that reserve, you need to drag that into your disposal calculation, which increases your loss on sale.
Exactly. And the report says most candidates simply ignored it. They left the money in the reserve. Or some knew the role, calculated it, but then didn't actually put the adjustment in the spreadsheet.
That is a technical detail that separates the amateur from the pro. But Woodfleet had another trap, didn't it? The hedging issue.
The Exhibit 2 problem. This connects back to what we said about reading the question. The scenario involved a hedge, and the text in the exam explicit stated, the hedge effectiveness criteria are satisfied.
So the exam effectively told them this is a valid hedge. It's a fact.
Yes,
Yeah.
It was a given. But what did the candidates do?
Let me guess. They explained why it was a valid hedge.
For 10 minutes, they wrote paragraphs analyzing whether it qualified as a hedge. They went through the criteria of IFRS 9, checking boxes that the examiner had already checked for them.
Why do they do that? Is it just insecurity?
It's comfort. They memorized the criteria, they saw the word hedge, they wanted to show off that they knew it, but the question asked for the accounting treatment, how to book the numbers.
So they spent their time, buying something that had zero value.
0 marks. And that is why they ran out of time for question 4.
Let's move on to question 2, to Coco.
This one felt different. It had a very strong human element, ethics and revenue.
The Takoko scenario is a great example of the ethical blind spot. So here's the setup. You have a financial accountant. They are looking at a spreadsheet of inventory. The system lists a component as new.
Yeah.
But the accountant looks at it and realizes, wait, we haven't manufactured that part in years. That is definitely old stock.
So the computer says new, but reality says old. And the accountant is under pressure.
Right. The financial controller has a bonus tied to profit. The accountant wants a permanent job, so the accountant ignores their own judgment and follows the system. They leave it valued as new.
Most candidates are good at spotting the self-interest threat here, I imagine. Oh, he wants the bonus, she wants the job.
Yes, spotting the motive is the easy part, but this is SBR. You need to spot the accounting error caused by the ethical breach. If that component is old, it's likely obsolete. In accounting terms, its net realizable value, what you can actually sell it for, is probably lower than its cost. The rule is lower of cost, or NRV.
Exactly. By keeping it at full cost because the system said so, the inventory is overstated and the profit is overstated. The report notes that relatively few answers connected the ethics back to this specific valuation error.
They focused on the behavior, not the numbers.
And even on the behavior, the advice was weak. Candidates tend to say things like, the accountant should refuse to do it or tell the board.
Which is a bit idealistic, isn't it?
It's not actionable. The report emphasizes that candidates failed to discuss documentation. If you are in that position, you need a paper trail. You need to document why you think the inventory is old, investigate the error professionally. That is what the examiners wanted to see.
Takoko also had a tricky revenue recognition issue with an upfront fee, $120,000 paid in advance.
This is a classic trap. A company charges a joining fee, the cash hits the bank, the instinct is to scream, revenue, and book it all immediately.
But under IFRS 15, you can't do that unless you actually did something for that money right then and there.
Correct. Usually an upfront fee doesn't transfer a distinct good or service. It's really just an advance payment for future services. So you have to spread that $120,000 over the contract term.
That part makes sense. But then there was the tax twist. And this is where the wheels fell off for a lot of people.
It involves IAS 12, deferred tax, the interaction between the accounting world and the tax world.
Walk us through that.
Okay, so in your accounting books, you are spreading that revenue over, say, 2 years. You aren't showing it as profit yet.
Right.
But the tax authority usually operates on a cash basis. They see the $120,000 hit the bank, and they say, thank you, pay tax on that now.
So you have paid the tax bill, but you haven't recognized the income in your books.
Exactly. You have a mismatch. You have an asset. Essentially, you've prepaid a tax liability for income you'll recognize later. This creates a deferred tax asset.
And the candidates missed it.
The report says answers on this were very weak. Many candidates either ignored the tax implication entirely or said no adjustment was needed. It shows a lack of holistic thinking.
Let's talk about the problem child. Question 3, Arundel Co. The report says this is often the worst performing question on the paper. Why?
It comes down to lack of preparation and just sloppy reading. Arundel covered assets held for sale and impairment. These aren't obscure topics. They are core standards.
Let's break down the assets held for sale issue first. This is IFRS 5.
The rule is deceptively simple. When you decide to sell a major asset, you classify it as held for sale. At that moment, you measure it at the lower of its current carrying amount or its fair value, less cost to sell.
Less cost to sell. I feel like that's the part people forget.
They do, or they try to get creative. The report mentions candidates trying to revalue the asset after it was already in the held for sale bucket. You can't do that. Once it's in that bucket, the rules are locked.
Then came the impairment calculation under IAS 36. This involved a cash-generating unit, or CGU.
This is where the logic needs to be sharp. A CGU is basically a business unit. To see if it's impaired, you compare its carrying amount against its recoverable amount.
Like for like.
Exactly. But here is the nuance. The recoverable amount, often based on future cash flows, doesn't typically include cash flows from current assets like inventory. It's about the long-term assets.
But the carrying amount of the division usually includes everything. Inventory, receivables, cash.
Right. So if you compare the value of the long-term assets against the book value of everything, you're comparing apples to oranges. You have to strip the current assets out of the carrying amount before you make the comparison.
And the report says candidates failed to do that.
Many did. But even worse was the allocation error. Let's say you find a $10 million impairment loss. You have to reduce the value of the assets. The rule is reduce goodwill first, then other assets pro rata.
But you don't reduce everything, do you?
You do not reduce cash. And you generally don't reduce inventory below its recoverable value. But candidates were blindly allocating the loss to the cash balance.
They were impairing cash.
Yes, which is, well, it's impossible. If I have $100 in the bank, it is worth $100. I can't write it down to $80 just because the factory is failing.
That's a fundamental misunderstanding of what money is.
It is rote calculation over logic. They learned a formula and applied it blindly without thinking, wait, can I actually impair a bank account?
That brings us to the final question. Question 4, Carol Co. This introduced a new player to the game, IFRS 18.
The new standard on presentation and disclosure. This is the examiner signaling, we expect you to be current.
And they specifically tested MPM's management-defined performance measures. This sounds like corporate jargon.
It's a very important concept. Companies love to report things like adjusted profit or underlying earnings. IFRS 18 now wraps some rules around this so companies can't just make things up.
So the question asks candidates to identify valid MPMs.
Yes. And the report highlights a specific distinction. An MPM must be a subtotal of income and expenses. So adjusted profit before tax is an MPM. It's a subtotal.
What about something like gearing?
That's a ratio. It's not a subtotal. Therefore, under IFRS 18, it is not an MPM. The report says many candidates failed to make this distinction, even though ACCA had published specific articles on this exact topic.
That feels like a clear warning. Read the technical articles. They're giving you the answers before the exam.
It is the easiest way to get marks. If a new standard is out, read the article. It will be on the exam.
The final piece of Carol Co. was about financial instruments, IAS 32. The convertible confusion.
This is always a headache. The scenario involved convertible loan notes and convertible preference shares.
To a layman, those sound pretty similar.
They do, but in accounting, they are different beasts. A convertible loan note is a liability, but convertible preference shares are often a compound instrument, part equity, part liability. Candidates mix them up.
And there was a math error here involving discounting that the report flagged as poor.
The discount rate error. To figure out the value of the liability part of a convertible bond, you have to calculate the present value of its future cash flows.
And the question is, what interest rate do you use?
Logic dictates you use the market rate for a similar debt without the conversion option. You want to know what the naked debt is worth.
But candidates use the coupon rate, the actual interest rate on the bond.
Yes. And if you discount a bond's cash flows using its own coupon rate, do you know what you get?
You get the face value, the principal amount.
Exactly. You end up proving that $100 equals $100. You have done a complex calculation to arrive at the starting number. It proves nothing.
Again, it's plugging numbers into a formula without understanding why the formula exists.
And many candidates just left it blank. They saw the calculation and gave up. Which brings us back to strategy. If they hadn't wasted 15 minutes in question 1 proving that a hedge was a hedge, they might have had time for this.
It's all connected. So stepping back, looking at this battle report as a whole, what is the big takeaway for you?
The takeaway is that technical knowledge is the baseline, not the differentiator. You can memorize every standard, but if you cannot apply it to the messy, specific facts of a scenario, you will struggle.
You need to manage your time marks per minute. You need to read the specific verbs. Are they asking you to calculate or explain?
And you need to check your logic. Don't impair cash. Don't ignore the tax man. These aren't just rules. They are logical frameworks for how business value is measured.
I want to leave everyone with a final thought, something to chew on, which goes back to the Coco ethics case.
The inventory valuation.
The report implies that the difference between a pass and a fail, and really the difference in your career, is the difference between a data processor and a professional.
That is the crux of it. If you see a number in a spreadsheet, like that new component that you know is old, and you ignore your instinct because the system said so, you are a processor. A processor gets replaced by AI.
A professional asks, does this make sense?
The examiners are looking for the professional. They want the person who says, this number defies logic, and here is how I'm going to document and investigate it. If you can shift your mindset from answering the question to solving the business problem, not only will you pass SBR, but you'll actually be ready for the job.
That is a powerful place to end. Don't just calculate. Think. Thank you for joining us on this deep dive into the SBR Examiner's Report. Hopefully we've made the battlefield a little clearer for you.
Good luck with your preparation.
See you next time.